When you think of trillions of dollars moving through the global economy, what comes to mind? Probably emergency summits, dramatic votes in parliament, or maybe breaking news alerts flashing across your screen. But the truth is, the largest financial shifts of our time happen almost silently. There are no screaming headlines, no heated public debates. There isn't a single moment you can point to and say, aha, that's when it all changed. This is the story of the quiet system, the invisible machinery moving trillions behind the scenes. Modern governments have become masters of subtlety. They rarely move money in obvious ways anymore. Forget sudden headline-grabbing tax hikes or highly visible, unpopular spending cuts. Instead, they rely on complex structures that work slowly, legally, and continuously. These mechanisms operate through things we hear about all the time but may not fully grasp: inflation, interest rates, debt refinancing, and central bank policies. These tools don't feel dramatic on a day-to-day basis, but over time, they completely reshape the entire economic landscape. Nothing explodes, nothing collapses overnight. The system simply adjusts. At the very heart of this process is government debt. Now, most of us think of debt as something that has to be paid off, right? Like a credit card bill or a mortgage. But for modern nations, debt works very differently. When government bonds mature, they aren't repaid in the way you and I would repay a loan. Instead, they are replaced. Old debt simply rolls over into new debt, year after year, decade after decade. The obligation is always there, but its real weight, its actual burden, changes over time. How? As prices rise and economies grow, yesterday's massive debt becomes easier to carry, not because it magically vanished, but because the purchasing power of that money quietly declined. $1 billion from 1990 just isn't the same as $1 billion today, and this brings us to one of the most powerful, yet misunderstood, forces in the system: inflation. We often hear about inflation as a problem, a failure of economic policy. But it also serves another function. Inflation acts as a silent redistribution mechanism. When prices rise faster than the interest you earn on your savings or the fixed income you rely on, value is subtly shifted from one group to another across society. Savers, for example, lose purchasing power. Their money in the bank buys less and less. On the other hand, borrowers gain relief, as the real value of the money they owe shrinks. And who is the biggest borrower in the entire system? The government. This transfer of wealth happens automatically. No new law needs to be passed. No official announcement is required. It's a built-in feature. Interest rates add another fascinating layer to this quiet system. Imagine a scenario where inflation is running at 5%, but the interest paid on government bonds is only 3%. On paper, lenders get their money back with interest. But in real terms, after accounting for inflation, they've actually lost 2% of their purchasing power. This is what economists call negative real interest rates, and it has been one of the most effective tools used by governments to reduce their debt burdens without ever having to officially default or make painful spending cuts. From the outside, everything looks perfectly stable. Bonds are honored. The markets function. But underneath the surface, trillions of dollars in real value are slowly and quietly shifting from lenders to borrowers. So, where do central banks fit into all this? Think of them as the system's chief engineers. Their job is to keep this massive, complex machine running smoothly. They do this by buying government bonds, providing liquidity to the banking system, and stepping in to calm markets during times of stress. Their primary role isn't to eliminate risk altogether, but to manage it, to spread it out across time, across different financial institutions, and even across different currencies. The result is a system that can absorb immense pressure without breaking, at least in the short term. They prevent sudden shocks from turning into visible, public crises. This all sounds very abstract, so let's ask the most important question. Who actually pays the price for all this? The cost isn't borne by one single group. It's distributed quietly and widely across society. It's paid by households holding cash. As its value erodes over time, It's paid by pension funds that rely on fixed returns to meet their obligations to retirees. It's paid by workers whose wages don't keep up with the rising cost of living. And it's paid by long-term bondholders who receive less real value back than they originally lent. No single group feels the entire impact all at once, and that diffusion is intentional. A slow, gradual adjustment faces far less political resistance than a sudden, sharp shock. And that is precisely why there are no headlines. Crises make the news. Slow, methodical processes do not. As long as the financial plumbing works, payments clear, markets stay open, and institutions appear to function as normal, there's no obvious moment of alarm. It's only years later that people might look at their bank statements and notice that their money buys a lot less, their savings grew much slower than they expected, or that the financial assumptions they built their lives on have quietly shifted beneath their feet. By then, the massive transfer of wealth is already a done deal. Governments, regardless of their political stripe, prefer this system because it allows them to manage enormous financial obligations while avoiding direct political backlash. Announcing a new tax creates immediate opposition. Quietly letting inflation erode the value of debt creates a kind of passive acceptance. Once these mechanisms are built into the very structure of the financial system, they don't require constant, difficult decisions. They operate largely on autopilot. Now, it's important to understand this isn't some grand conspiracy or a secret backroom agreement. It's simply how modern financial systems have evolved to manage large, debt-heavy economies without lurching from one crisis to the next. The most important thing to grasp is this. In an economy, money never really disappears, it just moves. It moves through time, it moves through inflation, it moves through interest rates, and it moves through the very institutions designed to make these massive shifts feel almost invisible. So the next time you hear about trillions of dollars in government spending or debt, remember this. The biggest financial changes of our era don't arrive with breaking news banners or dramatic speeches from world leaders. They arrive silently. They are hidden in plain sight within economic data, on central bank balance sheets, and in long-term trends that unfold over decades. The quiet system keeps working, trillions keep moving, and most people never even see it happen. Thanks for watching. If you found this interesting, consider subscribing for more deep dives into the systems that shape our world. See you next time.